All right, so what's up, YouTube? This is for the YouTube. I'm obviously not a financial advisor. You know the deal. So yeah, I just need to say that little disclaimer before I start the video. All right, so this is my Sunday night class. So how's it going, guys? So obviously you know me. In today's class, I'm going to be going over how I do my risk management. So I'm basically going to be going over two types, and I'm going to be going over what I do and then what I think another method people do which can still make you profitable. My way's a little different, obviously. If you guys have watched me live trade, right, I can tend to put my stops to break even a little quicker than most. It just depends on I have rules for myself. So it depends on if I'm green or not, if I haven't taken a trade, if I'm red, stuff like that. Okay. So yeah. Also, by the way, I don't really have a prediction yet this week. I'm going to be honest. Really, the only place I'm really generally looking at is these 15-minute equal highs. So if we've not hit these by tomorrow morning, I'll probably be looking for a long setup up to these. That's really the only thing I got on my mind right now. Really, everything else, I'm not really predicting anything yet. I just want to see how tomorrow goes first, and then we'll kind of go from there. So, obviously I'm going to be going over entries and exits, okay? And I'm going to be going over what I do. Okay, I'm going to be going over a couple of trades. I'm going to be going over the trade I alerted last week in my live trading, and I'll kind of show you what I did for that. Okay, so I'm just going to be going over a few examples, okay? And I'm going to be going over some examples where I didn't take, and I'm going to be going over examples of trades that I did take. So the first one, obviously, I'm going to be going over the example of a trade I took on, I think it was Thursday, I'm not mistaken. I was on NQ actually. Yeah, it was on Thursday, I believe. This is the one I alerted to my live Discord. Yeah, it was right here. Okay. So this is all going to be based off of ICT, obviously. Okay. But yeah, so this was the trade I took on Thursday in my live trading chat. Okay. And what I basically did. So if you guys did not see my Twitter post, I said I generally believe this. I have one of the best ICT strategies on Twitter, which basically what I do is if I see a fair value gap like this and I see us return to it, this is kind of big to the point where if you did take this, right, if you blindly take this, right, you can put your entry anywhere. You could put it at the consequent encroachment, right, which at this spot you would not get filled, and your stop would be where? The swing high. Then your take profit would be this low. Okay, obviously your risk reward isn't going to be as much, and you're not going to get filled here. But really, when you're entering in a fair value gap, you can enter in a lot of different places. You can enter at the CE. You can enter at right at the beginning, right? So what most people generally do is they enter right when we tap into it, and obviously the risk reward is very skewed at this point. So personally, I don't like either of these ways. So what I do is instead of actually putting a short limit anywhere inside this fair value gap, because I don't like the idea of, okay, you could literally put your short limit anywhere in this fair value gap. Instead of doing that, what I do is I wait for a confirmation entry. And what that means is let's say I think there's liquidity down here, okay? Right, let's say I think there's liquidity down here. And I am not going to blindly just put a limit anywhere in here because we could, theoretically speaking, we could literally reject anywhere in this fair value gap. And this is just one of those fair value gaps where because we already hit low day and because we've already took out all this liquidity right here, right, it's not one I'm going to blindly short. I'm going to be very careful. Okay, so what I mean by that is I'm going to wait for a confirmation entry. So in this scenario, let's say I think the liquidity is right here. So being that this fair value gap is kind of big and you can put your limit anywhere, instead, what I do is I wait for kind of a second candle. So I wait for a rejection candle off this, and then I enter that. So in this situation, we actually never got it. Okay, it looks like we did, but we didn't. Okay, so look what happens. If I go to replay mode right here, okay, and we go to replay mode right here. Okay, the confirmation entry I am looking for is something like this. Okay, why this? Because now what I've seen here is, okay, I've seen we fully rejected this fair value gap, which is good. Now I'm looking for a second fair value gap to form. And you can see right here, here's a second fair value gap. And it's okay, now what's your risk reward? Your risk reward is much, much tighter. And And really, in this situation, you could make your stop tighter. You could put it over the candle's high for this. Like, you don't even have to put it in over the swing low at this point, right? Because this is such a smaller fair value gap where if we really violated this fair value gap and came up all the way to the swing high, the chances that that's going to happen is very slim. And because this is the confirmation entry, you kind of want to make it smaller anyways. Okay, so what I do is, instead of entering here, I wait for the second entry, which would be this. Okay, but when do I not enter? If I see something like, if I see us go into this fair value gap, ready? So if I just replay this, right? Right now, I still have a limit here, and I'll usually generally put my limit like right here instead of right here, because this is so small where it's like a 1-2 point difference. So like in this situation, the only way I'm leaving my limit here is if we don't hit this low first, okay? So, and this is really important to understand. Let's say I think there's an external liquidity down here, but internal liquidity down here. And by the way, everything I am saying goes to the higher time frame as well. This all goes to the higher time frame. Okay, so right now, let's say I think there's liquidity down here. What I like to call this is I like to call this home run liquidity. Okay, when you talk about home run trade, like an options trade, right? It's 1,000% trade. Okay, this is generally the home run trade. This is like the scalp trade. So you got the home run liquidity, and then you got the just like basic take your gains liquidity. So usually whenever I see, so the basic take your gains liquidity, this is what you call internal liquidity, right? It's internal, it's inside the range. But the home run liquidity, this is what you call external. So what I like to do for my my strategy, like my risk management strategy, what I do is, if we don't hit internal liquidity and we retrace back to this fair value gap, the confirmation fair value gap before, I'll enter. Okay, so I am entering, as of right now, I'm entering this trade. I am putting a sell limit here. I am entering this trade right now. Okay, and I am entering this trade. Okay, but what happens if something like this happens? Okay, now I see we hit internal liquidity. Okay, and the reason why my rule is what it is, the reason why I say, okay, I'm not entering this if we hit internal and come back. I'm only entering if we don't hit internal. Okay, the reason why is because you can almost guarantee, like, okay, when you reject the fair value gap and you see a nice down candle, you see momentum out the fair value gap, right? What I've taught in a lot of different places, I've taught this in liquidity, like in my Twitter threads, I've taught it on YouTube, right? When you reject the fair value gap, right? When you come down from a fair value gap, when you get momentum, we respect the fair value gap, we fill it, right? But in filling doesn't have to mean fill the whole thing, right? This means you rebalance it. You don't have to fill the whole thing. Like, you don't have to go over the whole thing, by the way. So basically, this is what a rebalance fair value gap is. Once this gets rebalanced, okay, even if we don't go to external liquidity, the chances we don't go to internal liquidity are very slim. So my thinking process is, whenever we reject the fair value gap, we always must hit some sort of liquidity. So in this situation, right, my target, I know the draw after we rejected this fair value gap, I know the draw is always going to be this low no matter what. Okay, even if I don't know for sure it's going to be this low, it's always going to be this low. So the reason why I love to enter these confirmation fair value gaps and put my kind of take profit like this, right, is because even if we don't hit these external liquidity, I always usually know we're going to hit the internal liquidity right here. So this is what I call a confirmation entry, where I'm entering right here and I'm at least targeting this. Okay, and the reason, and this is what I do. So let's say I think we're going to hit this external liquidity, and let's say price does go back up here. Okay, I'm entering, and this is where my risk management strategy comes in. So what I do is, I see this is a 1.3 hour trade, okay, and I see this is a 2.59. So let's say price comes back to here and I get filled. Okay, what I do is I enter here, stop is here, okay, and I always take at least 40-50%. Like if I'm in like 5 contracts, I'll usually take off, it depends on the day, but I would say at least 2, if not 3 internal, and then I'll leave the other 3 or 2 for external. Okay, you don't want to take off your full position here because you still think liquidity is down here. But the beauty of retracing to here before we hit internal is, even if we do something like this, right, where we do this and then we go back up, we hit the stop and then go down, okay, at least you were able to scale contracts. And this is why my risk management strategy is what it is, right? If we kind of look at this replay, what happens? Okay, so now that we hit this, right? I'm not putting my limit here anymore. Okay, so if you look at this replay, I'm not, now that we have internal, I'm taking off my limit. I'm not entering the trade because we've already kind of hit this internal liquidity, right? So now that we've hit this internal liquidity, I'm not going to risk this again because I don't know if we're going to go back to this internal liquidity. I still have the target of external, but why would I try to re-enter when if I did get the entry, at least I know we would hit here. Okay, it just makes no sense, right? If I keep replaying this, look what happens. Right there, look, I would have gotten stopped out. So right here, you can see if I had my stop here, even if I had my stop above the swing high right here, I still would have gotten stopped out. So what happens here is this is exactly why I don't, after we hit any sort of internal liquidity, I always put my stop to break even, right? Because let's say, right, let's say the scenario I said it played out. Let's say we hit this fair value gap, right? So let's say something like this happened, and then we hit this internal liquidity. Okay, what would have happened here is I would have scaled, right? I would have scaled 2 or 3 contracts here, and I would have left the other ones on, okay? And the other ones would have gotten stopped to break even, okay? But let's say I left my limit on, okay, left my limit on right here, and I got filled right here. What would have happened? I would have been stopped out. So this is why I always wait for entries, and I just make sure we have not had internal liquidity. So in this example here, we hit internal liquidity. So there's no way I'm re-entering when we get up here. Let's say we hit this and we had not hit this internal liquidity, then of course I'd enter because the least I can expect the target to go to is kind of the internal liquidity. Even if we don't get to this external liquidity right away, it doesn't matter because once we hit that internal liquidity, that's when you can either put your stop to break even or even scale 50, 25% of your trade. Right, and it's so important to make sure, like, okay, if we have not hit internal liquidity, it's going to be the better trade because if you're targeting a higher target, right, the least you can expect is for us to hit internal liquidity. Okay, and what happens is this, right? Let's say the market, let's say like you enter here, we hit internal. Okay, if you're right, the market will not come hit your stop loss. Okay. What happens every time, though, is once we hit some sort of internal liquidity, what can happen is we always go take out the opposite liquidity, then we take out the external liquidity. So what happens is in this situation is you can see like we hit the internal liquidity right here, and then we even hit it again, and then we go take it out. So the reason why I move my stop to break even is because if this happens, right, if I'm wrong and we don't hit this external liquidity, if this happens, and I put my stop break even here, a stop at break even after you hit internal liquidity is really good because if you're wrong, at least you're going to get stopped at break even because if you get stopped at break even, right, and you're wrong, well, the market's going to go back up, hit that other liquidity, and then reverse. So it's basically once we hit internal liquidity, I always put my stop to break even or I just scale half because what can happen, especially depends on the conditions, right? If it's search and destroy, right, what's going to happen is we're going to hit internal liquidity, and then we're going to go back up, hit external. This is where turtle soup entry is coming, by the way. And then we're just going to keep doing that, and then we'll finally hit external. So, like, it's just the fact that if we did not hit this internal liquidity right here, like I guarantee you, if we did not hit this right here, okay, what would have happened is we probably would have just rejected here, and I bet you we would not have retraced back up here. But because we did not actually get this entry before we hit internal liquidity, what happened is we got the entry after, but it failed. We went through it, violated it, and then that's when you get your kind of search and destroy swing to the opposite upside. So really the basics of my risk management strategy for this is, right, I only enter if internal liquidity has not been hit. So if we just go back, right, this is when I'm entering. I'm only entering if we hit this fair value gap before hitting internal liquidity. And what I do is as soon as I enter, okay, as soon as we hit this internal liquidity, my stop goes to break even or I scale half. It just depends, right? But the good nice thing though is it's a free trade after that, right? As soon as we hit internal liquidity, it's always a break even trade, right? No matter what, I always put my stop loss to break even once we hit the internal liquidity because even though I may want this external liquidity, right, this is still a winning trade, right? Because when we reject the fair value gap, right, a winning trade is still rejecting this fair value gap and us going to hit some sort of liquidity. So like this is a winning trade for a scalper, and maybe I'm not trying to scalp this. Maybe I'm trying to hold the external. But the least that you know is, okay, once we hit this internal, put your stop to break even, because chances are if we hit internal and then go back out to my break even stop, we're probably going to retake out this high, because once we kind of reject the fair value gap, you should expect us to just go right to the target. You should not expect us to reject the fair value gap, and then you should not expect us to go like way back up and then down again. Once we reject the fair value gap, the market will usually redeliver to some sort of liquidity, whether it be internal and then external, or whether it be internal then the opposite range liquidity then external. Okay, but it always is going to hit at least one of them. So the beauty of my method is the first time it hits internal, it's a free trade every single time. Okay, so that's kind of what my theory is, right? And this is how you can either hold home run trades or just kind of hold for that 5-point, 10-point take profit, right? Like this would have been almost a 20-point move on NAS. So yeah, the higher so Alpha Profits is wondering, is this fair value gap still valid now that we've kind of rebalanced it? A fair value gap is always valid unless we violate it, right? This fair value gap right here, it's always going to be valid until we kind of violate it and close above it. But the thing is, you don't really take a fair value gap twice unless you still know there's liquidity below. So this is a little bit out of my teaching topic, because I don't do teaching about turtle soups. But like, really, because we know liquidity is still down here, right? This fair value gap technically is still valid, but it's just not something I take a second time, you know? So to answer your question, yes, it's a fair value gap is always valid a second time until we actually violate it and close above it. But it's just, I have a rule, I never take a fair value gap twice. I know Turtle Super is 10 too, but that's just me. Jalen, I gotta see. I want to see how he kind of react tomorrow. I'm probably going to go in tomorrow with no bias. The only thing right now is the equal highs in NQ, which is bullish, but not bullish for that long because they're not even that far up. So, okay, so this is I'm going to be going over the trade I took. So this is the trade I took in my live stream. Okay, so this is another example. Okay, so right here, what do I see? I see we took internal liquidity right here, and we took internal liquidity right here. Okay, and what I see right here is I now see a bullish fair value gap and I see a bearish one, right? The bearish one is one we've already had. This is one I'm not shorting because this is the third touch. We've touched it, so I'm not shorting this, but I'll still watch it. Okay, and this is where reacting in live time comes in handy. So I'm now seeing this fair value gap up here, and I'm saying, okay, we're rejecting this fair value gap. And I see what? I see now we have equal lows here, and they're equal lows to the cent, right? We know these equal lows are important on NASDAQ because, right, it's a $13,000 index. The chances that we make equal lows to the cent is very slim, so the chances are these are going to be hit are pretty high. Okay, so right here, what you got to realize is we're still technically not bearish here, right? I know we have these equal lows, but if you short right now, it's kind of a gamble that, okay, we're going to break this fair value gap. I want to see a violation of this. I want to see a close under, then I want to see a retest of it. And this is exact play alert on stream. So right here, I see, okay, we closed under. Now I will short the retest. This is the play alert in my live stream. I shorted right there. Okay, this little wick up I shorted. Okay, then you can see we go to the equal lows. Okay, but how did I actually play this? So what I did is, again, we go back to my strategy of I want down here, but we have these equal lows here. So basically what my entry is, it's right when we retrace into this inverse fair value gap. I'm going to stay my stop is above this fair value gap high because really the proper stop loss for a inverse fair value gap is really a close above this. But really if this is truly bearish, we'll probably not go above the fair value gap high or the high created off the fair value gap, which would be this. And I'm pretty sure ICT would do the same stop loss as well. So like right here, right, this is internal liquidity, this is external liquidity. So what I do is I'm not really moving my stop to break even yet until we hit these equal lows. So right here, what happens is we hit the equal lows. Okay, and now I'm scaling 50, 75%. Okay, for the sake of my live stream, this was actually my only target. I was not targeting down here. So this is more of a hindsight thing. So I was actually out 100% here. Okay, but let's say I wanted this external liquidity. And let's say saw we hit these equal lows. Okay, because it is equal lows, I would probably scale more than usual. So probably 75% here, because what happens with equal lows sometimes is sometimes we do this. And then we go hit external. So I'm probably scaling at least 75% there. Okay, but like right here, okay, what you'll notice is this would have been my entry, my stops up here, or my stops to close above, whichever happens first. Okay, sometimes we can close above this but not actually hit this, and if we close above, I'm getting out mainly because it, again, for inverse fair value gap, the close is usually above or below the inverse fair value gap. So right here, what you want to do is scale 50, 75% here because these are equal lows. So I would scale a lot more than 25% just in case something like this happens. And I've told a lot of people this, right? Usually when we form equal lows live time, like let's say I was anticipating this to be hit, but then I see equal lows form, I'll usually scale more than usual because of these equal lows, because sometimes with equal lows, sometimes you can soup them, then we just go hit the high and then go down. So I'm scaling about 50, 75% here, okay? And right here, okay, right here is when I would not move my stop to break even until we hit these equal lows, because this is technically the internal liquidity. Okay, so right when we hit here, this is the internal liquidity. Okay, the reason why I'm not scaling my stop to break even here is because when I see us reject this fair value gap, it's just like how I explained before. When I see us reject this, the least I know we have to hit is internal liquidity, right? Which is these equal lows. So I'm not moving my stop break even until we do, because the chances are if we can hit this internal liquidity, I scale 50%, 75% up. The chances are if we came back up to my entry right here, okay, and I didn't move my stop to break even, the chances that we would go higher after going up to my stop to break even after hitting external liquidity is going to be much greater. So this is just another example where I would move my stop to break even right after we hit this. Okay, I wouldn't do it before, because if we do it before, sometimes like this can happen where we retouch the fair value gap and then we kind of go down. So you got to wait till we hit the internal liquidity. But once we do hit that internal liquidity, even if it's quick, that tells you, okay, move your stop to break even, because I know if the price comes back to my break even spot, we're probably going to just go back up and end up taking this high. Okay, and what happens is you can see we finally hit external liquidity, and then right here, okay, let's say you had a target further down. Let's say there's liquidity right here. Okay, let's say we never hit it. Okay, if you're not putting your stop to break even, watch what happens. We literally come and hit the break even stop, and we literally just explode up. Okay, so like, you know, at least if we hit external liquidity, you know to put your stop break even, because if you don't and we go back up to that your spot where you entered are, you're really gonna get like 80% of the time you're gonna get stopped. And what some traders do, and I don't get why, okay, what some traders do is they'll have their take profit like this, or they'll have their take profit like this, okay? They'll have it like this, and they just won't move a stop to break even. But if we understand ICT well enough, okay, so this is I've noticed a lot of more Forex traders and smart money concepts traders do this, right? Smart money concepts is a little different than ICT. It's a lot of stolen ICT stuff, but they kind of do this. But right here, what they'll do is they'll get their entry here and they'll try to hold it on here. And I seriously don't get this, because this is a situation where I know if we come back to my entry, I know I'm getting stopped to break even. Okay, like I know I'm getting stopped to break even. I mean, I know we're gonna hit the next swing high. So like right here, right? Because if we reject this, we hit internal liquidity, and we come back to my entry, right? That means the market wants to go for the opposite high. So this is just why I move my stop to break even after we hit internal liquidity rather than doing this. Okay. So I want to know, are you guys understanding it? What is the main thing I'm trying to tell you guys? Like, can someone summarize what I just said in live trading chat? I went over two examples and I kind of summarized it. Someone summarize what I just said. When I put my stop to break even versus when I don't. Okay, obviously leopard, but how? What about risk management? Okay, so what Inferno said, which is if internals hit, you need to take partials because there's always a chance. There's a chance you will retrace to entry before hitting external. Okay, that's close, but it's not fully correct because there's different types of traders. Okay, so what Smith said is take some off when you hit internal liquidity. So you guys are understanding the concept of when we hit internal liquidity, take some off. Okay, this is where it's going to differentiate for some traders. Okay, what some traders are going to do is they're going to allow us to hit internal liquidity. Okay, so they're going to allow us to hit these equal lows, and they're not going to take any profits. Okay, which is fine. You don't have to take profits in internal liquidity. The only thing I'm telling you is you should move your stop to break even once we do hit that internal liquidity. Okay, so do you get that? So you don't have to take profits at internal liquidity. Okay, you don't need to take profits here. All I'm saying is when you do, you should at least move your stop to break even. You don't have to take profits here, but you should at least move to break even because, again, when we hit that internal liquidity, there's a chance we come back and just explode through your first entry. And Frankie, you're like me. I would scale some here because I don't like losing trades either. So my personal way, I scale some here. Okay, other traders on Twitter, they might leave they're going to leave their stop loss. They're not going to move their stop to break even. They're not going to take profits. They're just going to leave their take profit here and their stop loss here. But from an ICT standpoint, I basically know I'm going to get stopped. I basically know I'm getting stopped if we hit internal liquidity, come back to entry. We're probably going much farther than entry, especially if we hit internal liquidity. So really the basics of what I'm trying to say is you don't have to take profits at internal liquidity, but you should move your stop to break even when we hit it. Okay? And this is where it's going to differentiate, okay? Some people, they don't take profits here. Some people do, okay? I usually do, but some people will leave their whole thing till down here. Okay, so it's not that you need to take profits here, it's just you should put yourself to break even here. Okay, because again, chances are you're probably going to get stopped if we hit internal, go back up to your entry, you're probably going to go farther than your entry. And this only works if we do hit the internal liquidity. If we don't hit the internal liquidity and we almost hit it and then go back up, okay, what happens sometimes is we just do this, we don't hit the stop, then we go back down. So, I mean, you can move your stop to break even once we get it to a certain extent, but I think the most important thing is you should move your stop to break even after you hit the internal liquidity. Yeah, so if you're on a funded account, a funded Apex account, what I honestly recommend doing is I take 100% profits here. I don't even hold till here. And those are only for the trailing drawdown accounts because the trailing drawdown account, if we hit here and you put your stop to break even and you want to hold all till here and you hold and we come back, your trailing stop is going to be like that. Like your trailing stop's going to come back up. Or on an Apex account or a trailing drawdown account, you should take at least every partial here, maybe leave one runner until here just in case. And that one runner gets stopped to break even, it's only going to move your trailing drawdown up by like $25, $50 depending on, or if it's an MES or mini or micro. Okay, so personally, you enter a trade on the retest of fair value gap. Yes. So really, just the difference between internal and external liquidity is you got to look for like price action. Usually, like external and internal. Okay, external is stuff like low day, high day. Internal is equal lows, equal highs within high day or low day. So like right here, we have low day, but we also have these equal lows right here. So I'd consider this a form of internal liquidity because this is a place the market's going to want to run because it is a place retail is going to have buy stops, but it's also going to want to target this because this is low day and it's like, okay, how many of your friends always say, okay, I'm putting my stop at low day? Personally, I hear a lot of people say that. So this I would consider internal, right? So the market's at least going to run this even if we don't run this, and then the low day would be external. Or what you can say is this is external. So this is internal. The lower day is internal, right? Because it's kind of like live price action during the day. And then an example of external would just be a low from like a weeks ago or maybe yesterday, the previous day low, or maybe a low from like weeks ago. Like if you closely look, this is a low right here. This would be external because it's a not live price action. Like it's kind of old price action, and it's price action from weeks ago. So I'd call this external, and then low day maybe internal. Yeah, exactly. Kind of what Leopard says. Higher time frames are usually external, right? Lows and highs from weeks ago, days ago, and then usually the live price action forming during that day is usually internal liquidity. A lot of scalpers target that. But do you type 1 if you kind of get the point of when you should move your stop to break even? Because that's like the main thing of this class you should understand. Okay. All right, now someone tell me why you move your stop. Okay, someone tell me why you move your stop to break even. Why did I explain? Why am I saying to move your stop to break even once we hit internal liquidity? Lock in the green trade, yep. So we don't get stopped out, yep. Risk off, yep. But what's the science behind the ICT? It's not only that it guarantees green, it also guarantees something else. Yes, basically what Smith said. If it takes internal and you start seeing reverse and come back to your entry, okay, the chances it goes way past where you entered before is very high. So putting us out to break even would just mean, yeah, so exactly. So it's really because if price hits this low, right? If price hits this low and starts reversing, comes back to your entry, it's probably going to go farther. Versus you want to see price hit this low and then hit this low right after. That's the best trade. That's the best case scenario. But that doesn't happen all the time. Sometimes we hit that internal liquidity, we come back to your entry, and then we go much farther. But I would say about 70 to 80% of the time we do come back to that entry after we hit internal liquidity. We usually end up going higher and be able to stop you out anyways. So it's two things, capital preservation and then the reason why I just explained, because usually when we hit that internal low, what can happen is we just do the Enigma pattern. If you guys don't know the Enigma pattern, it's kind of like a broadening formation where it takes us a while to hit like something like this. But that's the reason why, based off an ICT standpoint. Okay, yes, Common, I'll answer that question right now. There's a difference between kind of a seek and destroy pattern. Seek and destroy is a little different for now. Seek and destroy is much more complicated. Versus broadening formation, it's just a straightforward like this. Seek and destroy is like there's a pattern to it. It goes like, I forgot how exactly it goes, but it goes something like this and then boom, boom, like something like that. There's a pattern to seek and destroy, and there's just the broad information is more simpler. It's similar, but a little different. Okay. Yeah, I guess you can consider it the same thing. But there's like a pattern to seek and destroy. The ICT, it's a model. ICT goes over it. There's a picture to it. I think I have it somewhere in this Discord. Okay, so this is I'll send you the picture if I can find it. I know there's a model. Let me see if I can find it on Google real quick. It's this one. Alright. So it's like kind of like the broad information, it's just a little more precise. Okay, it's right here. So look in trading chat. I put it right here. Okay, so right here, you got buy stops orders, you create more buy stop orders, and you create more sell stop orders. You take out both, and then you take out the buy, then you take out the sell. So it's a little different than broadening, versus broadening is just up, down, like this is just more the profile for it. Common, give me a second, I'll answer. If the distance between yes, trash, and that was the other thing. So Trash Panda is saying like if the distance between internal liquidity and your break even is farther than the distance from internal to external. So you're so let me get this straight. What you're saying is what if external liquidity is way down here? Or do you mean if external is like right here? Yeah, give me a second, comment. I'm just trying to. I'm not trying to steer off into other topics right now. I'll answer it as soon as I'm done answering this. Do you mean if external is right here, or do you mean if external liquidity is like way farther? Yeah, basically Inferno. Oh, so you mean like this, right? If external is this close to internal, I just take all profits at internal because holding another 50% another point is not worth it to me. So if I see there's a low day right here, yeah. So if I see there's a low day right here and then external like an old low or right under, I'm gonna take 100% profit at internal because if we do some bullshit like this, like and I didn't take profit, that's just stupid. Most of the time we'll hit both if they're that close anyways, but what if we don't, right? I'll take all profit at this internal liquidity. One more second comment. Okay, Leopard said if we take external, we obviously reverse. We don't have to reverse every time you take external. That's another thing. We don't have to reverse every time you take external. That's when you look for the framework to reverse, right? You're not if there's no fair value gap over to the left here, you're not expecting reversal, but maybe when we hit external, that's when you start to look for the framework, but sometimes you don't get the framework, like the market structure shift, right? Sometimes you just don't get a market structure shift back to the upside once we hit an external. It obviously depends on the profile of the week, the daily, right? If we have more liquidity below or not. Are you targeting the next? Usually, after we take external, the first target I'm always targeting is the next high. So it would be this high right here. So when we reverse on Friday, obviously I want this high in the end, but like, because this is just the start of the buy model, right? Because this is like a, in theory, supply zone, right? You can see this is almost like a supply zone where we get giant dump here. There's not really any giant dumps here, but we get giant red candle here. So this is the supply zone I want to see taken out. So it's like I want to see this high taken out. But after you hit external, my first target's always going to be internal, right? Because that's the safest. This is like the low-hanging fruit that we should hit, even if we don't hit this. Yeah, I'm live streaming tomorrow AM session, Jalen. I'll do one free live stream this week. I'm not sure what day yet. Probably Thursday or Friday. For you guys, not a premium. Alright, so I'm going to answer Common's question now. Wait, why not take long? Okay, because you can't long after you hit some sort of liquidity. You can't long here. This is when you start to look for the framework, right? You look for what? The last fair value gets to be violated, something like this. Once this is violated, you long right here. By the way, yo, who was in my stream? Someone asked me about this. I think we were like right here. Does anyone remember? Someone asked me about this candle. They said, would this be a breaker block if we reverse above it? And I said, I remember this. Does anyone remember that? And I said, yes, it would be. And I said, actually, no, it wouldn't be a breaker. It'd be more of a reclaimed order block, and we want to see it use as support if we broke back above it. I don't know. So someone asked that. I forgot who it was. I don't know if they're in here right now, but they asked that Friday. I just remembered, actually. Or they asked it Thursday. I just remembered. Anyways, a little off topic. Yeah, this would be more of a mitigation block, but it really wouldn't be any block. It would be more of an order block because this isn't a swing high or swing low. Because it's not a swing high or swing low, it's more of a reclaimed order block. It was you, Natural. Yeah, do you remember? You asked me about this. I forgot what happened. I just realized in hindsight it actually worked nicely. Yeah. So common and asymmetric. So asymmetric, to answer your question, why not take? You can't just long here. Okay. If you see we're in some sort of bullish PD right to the left, maybe you can long when we hit this. But really, once we hit external, you can't just long. You have to wait for the framework, meaning you look for some sort of break and a violation of an old bearish PD array, which could be this combined. And then once we like break that, then you look for your fair value gap to enter. Here's where you enter. Right? You can't just gamble and guess we're gonna reverse that external every single time. You have to wait for the framework, which should be right here. Yes, I do over heaven. Just not every day. It just depends on the day. Okay, and then Common said, Common, you're still in here, right? Yeah, you are. Okay. I'm going to answer Common's question real quick. When do you decide to use the inverted fair value gap? Like, what frames your decision to use it instead of waiting for a fair value gap in your preferred direction? I really only like to use the inversion fair value gap when I see a really obvious sell side liquidity below. So like, because this was so obvious, right? If I see us, because in this leg, right? This is really the biggest fair value gap in this leg, and it kind of lines up with this too, right? See how it lines up a little bit, right? Because this lines up, this actually is a bad example. I'm just going to use this, so don't worry about this. But really, it's because if I see obvious liquidity right here, like if I see obvious equal lows or obvious sell side, right? I think we're going low a day. Maybe I see us rejected a higher time frame fair value gap. If I see obvious lows, I'm not expecting this to work in the first place, right? If I'm not expecting this fair value gap to work, if I'm expecting this to get violated and I'm not long it, well then, why would I not want to see this used as resistance, right? I would. Because I don't want this fair value gap to work in the first place, because I know liquidity is below, then this is the fair value gap I would like to see used as an inversion, right? It's really the fair value gaps where it's like a fair value gap where you say to yourself, okay, we took high day, right? We're not taking any bearish, we're not taking any bullish fair value gaps, right? If we take high day, right? Let's say this is high day right here, and we see a bullish fair value gap, you wouldn't really want to take in the first place. So then you really just want to see it used as an inverse if we see it, if we kind of see it dump below and close below. Right, and it's really the fair value gaps where you expect in live time, you do not expect it to work. So that's how I determine. If it's a fair value gap I don't expect to work in the first place, those are the ones I like to use as inverse. And it's like fair value gaps where we hit high day and there's bullish fair value gaps, right? I'm not going to take a bullish fair value gap after we hit high day, most likely, unless I know there's liquidity above. Or if we have if we hit low day and we got bearish fair value gaps. What about the last green candle just before 1040? Are you talking about this one right here? The last, you said, oh, this one. This one right here? This one? This red candle? $10.37. Oh, this one right here. Right here, right? This is the 10.37. You're talking about this one, Dark Mike? 10.37? Okay, well this is 10.37. This is a, I guess this would be more of a mitigation. No, this would be a breaker block. Because we take low a day, like we purge low a day. This is the last really good, this is, I don't really count this, but this is the last high probability green candle. We purge low a day. So when you trade above it, right, you can see us close above it. You want to now see it used as support, which it is. It just isn't retraced to a second time. So probably not an entry I would have taken, but really this is a valid entry because you see the candle close above this swing high, right? So now you just want to see this used as support. Yeah, I mean, this is a valid entry, but we never, like, it would have been better if we were tracing into this fair value gap, and then I would have definitely entered here and then got it. This would have been better, but I mean, this wick down inside this breaker block after you close above it, this is still a valid entry right here. And this is one of those low risk buys because there's not really any good market structure shifts here, in my opinion. I'd really consider this the market structure shift once we break this. But you don't really know that a lot of time until we get this candle. Then this candle, I'm like, okay, this is 100% bullish. I know we're hitting this. And then I don't enter here. This is more the low risk buy. This is a higher probability buy right here. And it lines up with this as well. So yeah. And my favorite PD rate is probably the inverse fair value gap. All right. So we really went over the big topic of, okay, it's at 45 minutes. So we went over the big topic of when I place my style to break even and kind of where I do that. Okay, the other thing I want to talk about is, yeah, you should not be long on a market structure shift because you don't know if it's a market structure shift until we get displacement. Henry, I can in another. I'll do that next Sunday. This is kind of more of a risk management class. I can do inverse fair value, I guess, for next Sunday probably. Yes, I know, Metzi. This is an example where this is also a 15-minute fair value gap. So you could have long this because it's a bullish. Like if this was not here, then I wouldn't even thought about longing this, right? But because it is, you can kind of long it. What else I wanted to look at? Yeah, so that's basically kind of the basics of, okay, here's where I put my, well, here's when I put my stop to break even. So that was the key thing you guys should understand. When you should put your stop to break even, when to capital preserve, right? Once we hit a certain price point, you know that you should put your stop to break even because you know if we come back up to your entry, we're probably going to go farther. So that was the main thing I want to talk about. We got about 10 minutes left. The other thing I want to talk about is take profit targets. Okay, I've kind of gone over those before, but let's say I look for a long here. Let's say theoretically we hit external liquidity, and let's say right here I long this wick, right? Why would you be able to long this wick, right? It's not a random buy in hindsight. It's a buy that you see. Okay, we broke above this breaker block, right? I'm gonna long this wick. Okay, really. I target the first swing high. Like immediately, my target's always the first swing high, right? Even if I'm not taking a profit the first swing high, I'm never really putting myself break even. So this time frame is a lot more interesting because on this time frame, this is the 1 minute. So like just from instinct, you're gonna be like, okay, this is the next swing high. I'm gonna target this. But some people ask me, right? You can see this by the way, right? There's no swing highs formed here. Right after the entry, there's no swing highs formed here, right? Until this one. Okay, and some people ask me, well, how do you know whether to target this one or whether to target this one? Okay, and the answer is you don't. If you're strictly on the 1 minute chart, no, Bamboo, I trade both. I think I can use my cleaner. It just depends on the day. I'll trade both. So it really depends on the day, right? My take profit, my first take profit, at least for 50%, is always going to be this high, right? Because I'm on the 1 minute most of the time. But a lot of people then wonder, like, how do you know whether we're going higher after this? Well, you don't. Okay, you want to see the displacement above this. So if you look at the 15-minute time frame, if you notice the 15-minute time frame, right? If you notice that, where is it? Right here? Yeah. Okay. If you notice on the 15-minute time frame that we bounce off of some PD array, then chances we go higher than just this swing high is pretty great. Okay, like the chances we go past this are pretty great. But you really need to be aware of, okay, where are we bouncing off the higher time frame? If you see we're bouncing off a higher time frame bullish fair value gap, right, then I would honestly expect this high because, again, where is the draw and liquidity after you bounce off a fair value gap? Usually the highest high. And in no man's land over here, this is the highest high in no man's land, so this is where my target would be. Okay? But in the 1 minute, it looks like, okay, all this would just be your target. But that's why you have to be careful. Like, if you're in the 1 minute and you want a higher, and you want a bigger move, just make sure you understand, okay, are we bouncing out of a higher time frame fair value gap? If we are, where would the target be for this? It would be right here. If we're not, then I'd probably just scale most here because I'm probably just expecting lower prices. But right here is when maybe I'd scale 50% or 75%. And this is where you kind of have to see, okay, what's the displacement going to be over this high? So far right here, this is not a lot of good displacement, right? So here, not a lot of good displacement, still not a lot of good. And then here, I'm like, okay, now we're really displacing over this high. Now I'd probably expect us to go high, like quite a bit higher. And then you go to higher time frame, see if there's any like 15-minute fair value gap, which there was. But like really on the 1 minute in live time, you don't know if we're going to displace above this high until we do. But you should have already been down from here, so obviously would have just been holding runners at this point. But like once you see this, then you know, okay, we're probably going to go hit this high. But yeah, that's just something that in live time, it's hard to tell. Like if you're on the 1 minute and you're not going to the higher time frame, right, you're going to miss these moves because you're not going to realize on the higher time frame we're bouncing from a higher time frame fair value gap, which means we should go much higher than this 1 minute target, right? If this wasn't a fair value gap in the higher time frame, we might have not even gotten to this high, but the least we could have done is gotten to this high, then dumped. So like if we weren't bouncing off a higher time frame PD rate here, I'm not really targeting anything past this, but if I see we are, I'll probably try to target past it. Don't worry about Romeo. So TV Swept says he's literally long in NQ right now. Okay, so let's go over a live example. Okay, so TV Swept says he's long NQ right now. Okay, why would he probably be long? I'm guessing this 15-minute fair value gap. Okay, isn't a discount? It doesn't look like it. Oh wait, it just hit discount. So just hit discount. Okay, just wick below. Okay, where would my target, like on the 1 minute time frame, right? This is a good example. 1 minute time frame, my targets would be, where would my targets be? Someone tell me. Out of 3 in this example. Oh no, I'd actually have 2 in this example on the 1 minute. Okay, new week opening gap's the first one. Right, so this is the open, or the close to the open, I mean. So new week opening gap is one of them. So this would be my first target. So this would give me about 7-point magnitude, or depending on where you entered, this would probably be about 10 points. So right when you touch into here, this would be my first target, and then where would my second target be? I'm waiting. No, Lewis, it would not be the equal highs because I'm on the 1 minute chart. I don't know those equal highs are above us. No, I'm never going to target a fair value gap to the left. Right? When if you expect us to bounce off this, you should not expect a rejection from any of this. Maybe a new week opening gap, but like I'm not going to care about a fair value gap in the south side of the curve, right? I don't care about this. No, new week opening gap. This just treat this as my whole target. What would my next target after new week opening gap be? Yes, the highest high. Exactly. So from the 1 minute chart, what I can see here is the highest high is right here. So 13,402. So it would be new day open or new week opening gap, and then just in case you're rejected, I would get out. So I'm here, and then I'd be here, and let's say still at a contract or two. Then I'd be looking for, okay, some people ask, how do you know if it's going to go higher than this higher high, right? That's where you'd want to look for the higher time frame and be like, okay, what do I see in the higher time frame? On the higher time frame, I see what? We took liquidity here. We took liquidity here, or we purged it, I mean. We bounced off a 15-minute fair value gap right here. Okay, and really because of this, I can say, okay, the higher time frame, I'd probably honestly target higher than this, right? I'd be like, okay, I see these equal highs. I'd probably actually target higher than this higher high and try to hold till here. But from the 1 minute, right, really we don't even know these are up there in the 1 minute. All we see is this. So I'd be targeting this, and then I kind of zoom out a little bit, see if I can leave a contract higher, and then this is where I'd be leave one too. So you guys who wonder, how do you know how much higher we're going? It's really the higher time frame, right? On the 1 minute, you're never gonna guess we're gonna go higher. Really all you care about is this, and then people always DM me, right? People always DM me this. We go way past this, and they're like, well, how do I know to go higher? Or how do I know we're gonna go higher? Well, I always say zoom out. See if, like, did you see these equal highs before? If you didn't, you probably wouldn't have known. But if you did, then I would have expected us to go higher. So in this situation here, it'd be the new week opening gap, this high, and then this would be my final target. The reason why this would be my final target is because I'm not sure in the bias this week, so I'm not sure whether we're going to reject this or not. But the least I want to see is this by tomorrow. Like this. You hold shift. Yeah. No, it's actually I actually do it perfect because I'm just built different. Yes, Eric comes in with financial advice. So we should all be trading kill zones, time and price. So yeah, I'm just talking about this right now, right? This is not a kill zone. You should not be trading this, although I'm bullish here, right? I'm expecting this long to work. If it doesn't, I don't give a shit because I don't trade this anyways. But yeah, basically, if you blow your account tomorrow, you can all sue Eric because he says to trade during the kill zone. So we got that under our belt. Well, I mean, you just said that we should only be trading kill zones, so you sound like a financial advisor. Do I trade Forex at all? No, but I go over Euro. I go over Euro USD a lot, just for kind of practice. This definitely does not look bullish. Looks like we're gonna go for this low. I don't really know though. I'll have to kind of monitor tomorrow, but really my condition right now is we kind of got this daily fair value gap here. We took buy side right here, right? So I'd expect us to probably go for this low and then after kind of reassess. But yeah, this looks bearish for sure. Right, we took this high. I expect us to go for this high actually. I'm expecting us to go for this high, but the daily's more bearish right now, so maybe something like this possibly. Soon LP. But so far this is working nice. Okay, this is a textbook long. This is a textbook long right here. Okay. Like I said, I expected this long to work. Like this is not a dumb long at all, right? Why did I expect this long to work? It's because it's a 5 minute fair value gap. right? This is just a textbook long in general. So that's why I told TV Swap I'm expecting it to work. Okay, so really, this is the. So this would be my first target right here. As soon as we hit 1370, it's about 3 more points. And then once we hit this, I try to keep holding longer. Yeah, Metsy. So yeah, do you guys all expect? Do you guys understand why I said I expected this to work, even though it's not a kill zone? Type 1 if you do. My stop would now be under the swing low, probably. My initial stop would have been here, but now my stop. So let's say I want it at least here or at least here. Okay, once we hit, like my stop would still be right here. Okay, and my first target would be here. Once we hit this, like once we hit my first target, right? Once we hit this new week opening gap, I immediately put my stop to break even right here. So this is when I put my stop to break even. Yeah, Asia on Sundays are not bad. I'm not going to lie. Sunday night openings are not bad. Like this is not bad at all. Like if you guys have been to my classes in the last like month, I seem to call the stuff every single Sunday. Right? If we got this long right here, right? When would I long this and when would I not long this? Someone tell me quickly. So I would long it right now. If we were traced right here, I would 100% long this. Right here, I long. But if we hit new week opening gap first and then we went down, I would not long it. Okay, and so I'm going to explain why I do that based off of what I taught you earlier. Exactly. So like Roy says, yes, it is in discount. Pipperella. This would be in discount. It's because the least I can expect price to go right now is this new week opening gap. So if we hit here before the new week opening gap, I at least expect price to go here. But if we hit new week opening gap and then come down here, well, I can't be confident we're going to go back up. That's why I would only long before. And that's when, if I was confident we were going to at least hit new week opening gap, the least I could do is move my stop to break even. Right? If we came down here before hitting new week opening gap, I can move my stop to break even and then target new week opening gap. Versus if we hit new week opening gap first, I would not be able to move my stop to break even. Nah, I'd probably just long. Yeah, probably try to long this. Maybe bottom ticket, like right here. It's in discount. It's an inverse fair value gap. But I would not long this if we hit this. Yes, exactly, LP. Jalen, I passed my first ever funded on a Sunday. It was trap liquidity, just slow grind up. Nice. But yeah, so basically right now, if we were traced here, I'd probably try longing this. So hopefully you guys understand that. Okay, hopefully you understand why. Okay, kind of explained, right? Like, if we hit here and then went up and then we hit this, I could at least move my stop to break even. Versus like if we did not hit here, if we did not hit here, I can move my stop to break even. If we do hit here and then go back down, right, my next target's really way up here. So that means I probably wouldn't be able to move my stop to break even. If it's fast moving pace, I'll market order in, but if it's like slower, I'll like just put a limit like right here probably. Okay, I'm gonna do this for educational purposes. Okay. Obviously you should not play stuff during the kill zone or outside the kill zone, but this would be allowing an enter if we're inside a kill zone. So let's see if it works. I'll just put an enter here. I'm gonna end the class in a second, but I'll update you guys in trading chat to see if it works. Yes, I like to use 15-minute NQ breakers. Yes, this will be uploaded to YouTube. So I think this is about it for now. I think I went over everything I wanted to. I'll update to see if this works or not. Obviously, I would never play a real account during this time, right? I would wait for tomorrow morning, but... Okay, for right here, I'd probably place my stop loss. I'll probably do this. Stop loss below this low. I wouldn't have it below this low because chances are if we go below this low, we're probably going to go hit this low. So right here, I do it on the swing low before the fair value gap's created. And then I just do something like this. So like that. And this is also a 4-minute order block, 4-minute fair value gap. I literally cannot see how this fat. Like, I bet you this will work. Please do not take it though on a real account. Please, please, please do not. Like, if you do, I hope you lose. Because it's literally Sunday night. You should not be trading this shit. Yeah, exactly. I'm literally, like, we could bounce here. I'm expecting this to work. I'll just... Maybe I'm more confident to play like this. What I'll do is I'll do this. I'll enter one here and I'll just have like another order down here and just, yeah. Take profit up here. Actually, I'm not gonna do that. I'm gonna do one sell up here and then one stop, and then my stop loss is gonna be below here. And obviously this will change to 2. And then my other sell will probably be up here if we can get it, right? That'll be, I don't even need, like, this is the high of the new week opening gap, right? I don't really need the target higher because this is already a decent risk reward trade. Right, that would already be like a 3.5, which I don't really need more than that. I guess you could. Yeah, I guess you could. It's up to you, right? You don't have to use CE of new week opening gap. You can use a CE. You can use a low, right? I'll just change this to here because why not? I try to do 1 or 2. I would say like 1.5 R is my average, but sometimes it's 2, sometimes it's 3, sometimes it's 5, sometimes it's 1. It just doesn't. I never go below 1. It's always 1 R over. ICT said that, LP. Okay, when would I take this limit off? When would I take this limit off? Yeah, pretty much common. Yeah, where's in the chart? Like, when would I can't take this limit off right now? By the way, I want to see this get violated. Exactly, this ITH. So if we can hit here, and my take profit's up here, the second we hit here, I'm putting my stop to break even, and I'm taking my limit off no matter what. Because if we hit here and we come back to my entry, which would be right here, chances are we're going 5-10 points lower. And I don't want to put myself in that much drawdown. So this is where I'd obviously put my stop to break even once we hit this high. Which just kind of lines up with the new week opening gap. So, yeah. I don't like how he rejected this. Obviously, this is the fair value gap you want to see violated. Looks like we are going to go with discount here in a second, but... Wait, LP. Oh, ICT said that? He said, are you talking about for this week? So, he said, weekly candle offer 2-sided delivery in the hourly for NQ for the liquidity void, which should not be offered on the weekly. Wow, what a gap up. Are you talking about the liquidity void he said we are going to hit last Sunday? Or last... I'm confused. What are you talking about? Wait, I can't hear you. 1 second. Turn to my mic. Alright, talk now. because we already filled it, I wouldn't. But if I would only worry about it again if we kind of break above it. And I think that's what he means, because if we break above it, that's when I would start worrying about it again, because I don't want to see that use as support. Oh, yes. And yes, I'm already bullish on the weekly time frame, even without the liquidity void. Yeah, but when we usually wick through a liquidity void, yes, we usually end up filling it. We usually end up closing above it at some point too. So your answer to the question is yes. Yeah, no problem. All right. Well, this is going to be recorded. Obviously, I'm looking for a bounce here. Do not trade it. This is obviously for just educational purposes only. But I'm expecting something like this to work. Let me check ES real quick. Yeah, ES looks pretty good. ES, the least I want is this high right here. ES obviously looks way worse, right? Same thing on ES. I'm expecting this to work. Even though it's Sunday, I'm expecting this to work. Right here, I guess my entry and stop loss would be like probably right here, and then I'd at least target here. As soon as we hit here, my stops to break even, and then I obviously want this high right here. But yeah, so there's equal lows here. All right. Yeah, you guys should all demo this. This is a good demo trade, especially for being a Sunday night, right? It's good to journal a trade like this. But yeah, this is definitely a good demo trade, right? Not a real account trade because it's Sunday night, right? I physically and mentally, and I don't care what price does when I'm asleep. I don't care what price does tonight. I don't care what price is doing until I wake up tomorrow morning, right? This is just for educational purposes, as I said. But I mean, it looks textbook, you know, so it's just a good demonstration, good exercise, maybe to try it on demo. All right, I think that's it. Don't really got anything else. This will be recorded and uploaded to YouTube, so expect that. Okay. Oh, Inferno's got a question. Hurry, ask it quick. Got 5 seconds. How do you identify manipulation lags? A manipulation lag would be something like you look for consolidation. So you look for some sort of like consolidation, and then you look for us to go under that consolidation. So, I don't know. Jeez, I don't know. I guess something like. Let me turn this off. I'm gonna try the hourly maybe. So you want to look. Oh, right here. So see how we kind of consolidate here a little bit, right? A manipulation lag would be a leg that is we have consolidation and then we kind of knife under that consolidation, and it has to be inside of some sort of bullish PD array. And then this would be your manipulation leg, this red candle, because we're knifing below consolidation into a higher time frame bullish PD array, and then then you'd expect the distribution leg after the manipulation here. So this is the accumulation. This is the yes, manipulation usually rejects off a PD array most of the time. So yeah, you can see ES finally just hit discount here. So you can see ES hit discount here. This is where I'd want just a quick bounce right here. I just want up just right now. I would not want to see this low hit again. See what's my IQ looking like. Boom, perfect. See how I said I could have bottom ticked that, right? See how this just perfectly hits this inversion, right? And this is where my initial limits was. Okay, and really in this situation, like I'm up almost 2 points here. In this situation, because like if this was the normal market hours, I'm up 3 points here now. because this is not the normal market hours, I want to do this. But if this is the normal market hours, and I was expecting myself to bottom tick on Q here, honestly, if we just gained a entry and I immediately got up 5-10 points and I'm green for the day, I'm immediately moving my stop to break even. I am not letting that go red, especially because this was such a good fill, right? We filled this inversion. It was in discount. Because really this is a good fill and I would be green for the day, I'm moving my stop to break even right here. If I had not traded for the day and I had no trades, I'm not moving my stop to break even. And if I was red for the day, I'd probably move my stop to break even because, yeah, I don't want to go more red than I already am. And this is such a good fill. But honestly, the only way I'd leave my stop right here is if I was break even, I had to take a trade for the day. I'd probably just see how this plays out. But yeah, this was such a good fill. I should have just left both my fill orders here because if we were traced back to this low, it might not work. I'm hoping the S kind of holds up here as well. Move stop loss to 1 point profit. Nice. Thank you. All right. Well, that's it for me. Obviously, I'll update on if this works or not. But yeah, I will see you guys tomorrow in live trading, my premium members. Yeah, so peace out. Everyone have a good night, and you can watch this on YouTube.